China's collapse is far worse than you think, according to Cathie Wood. The collapse of the Chinese economy has been the talk of many economists in the past months. The Chinese economy continues to thrive against the challenges, to the surprise of others, saying that the economic slowdown was due to the transition. Or are they only building this facade? One woman tells us that this facade is bound to fall. Cathie Wood, CEO of Ark Invest, compared China's rise to Japan's economic collapse in the early 1990s, which lasted for 30 years. Similar to how a housing bubble in Japan boosted their GDP, we are witnessing the largest housing bubble in history in China as we speak. More details regarding the current situation of the Chinese economy and its real estate crisis, do watch our previous video linked in the description box. If you did, please continue watching as the topic will be more exciting. Please consider liking and subscribing to our channel. Welcome to Marketify, where we'll give you the latest updates in the financial space as well as business. Traveling through cities across China, we will see numerous amounts of apartment complexes, office towers, and residences, all made of glass and steel. But here's the catch: they are no different from ghost towns and paper houses, as no one lives there. How come one of the strongest and fast-growing economies relying on its real estate has come to this? Perhaps the closest reason is the housing bubble that is happening right now. For the past decades, China's economy has been impressive, but a major contribution has been the real estate industry. To increase their real estate holdings in tens of thousands of cities, developers have taken out loans, as well as take mortgages before houses are turned over under the law. But what drove the Chinese citizens to agree to these terms? This is due to the continuous rise of prices in real estate. Due to the rising population in the past decades, housing prices continued to grow annually. This made real estate a profitable business that developers preyed on. As the Chinese citizens think that one should purchase a house now to buy it for a lesser price, they continued to buy properties near enough from the megacities. Developers anticipated this growth would continue, so they started constructing homes further and further out only to trip on their knees. What they had built has become a mere ghost town, a facade to make the Chinese population think that the real estate business will continue to grow. But as this torn down, the Chinese population is now holding on to their money and boycotting mortgages, causing the impending doom of its economy. This is further evidence of the increasing real estate bubble in China, a key factor in the country's economic growth. Let us look at the Kangbashi district located in Ordos, which was one of the largest ghost cities to be built and documented. Initially, it's projected to house a population of 1 million people. However, the city's population fell from 300,000 in 2012 to 100,000 in 2016. Ordos' new town was able to fill its empty houses only after the best schools were relocated within the city. Number of unoccupied apartments and condos is so high that Italy could be housed within them. With a 20-year run of appreciation, the value of China's property market has risen to more than $50 trillion, which is about equivalent to 4 times China's GDP and 2 times the US. The phenomenon is flagged by many economists as they claim to see the situation before America's 2008 recession happened. Greedy behavior of the developers, which continued to feed on the minds of the Chinese people, is now coming back as they face huge debts. Real estate giant Evergrande became the highest valued real estate firm after expanding its land holdings to more than 565 million square meters. This was only possible because Everland loaned over 300 billion as capital. Now that the situation has unfolded, credit unions as well as investors are flocking to Evergrande to take their money back. But Evergrande was not the only real estate firm affected in China. In fact, it is said that real estate developers are continuously growing bankrupt as we speak. The economic security of China is in jeopardy because of President Xi's activities. President Xi Jinping is aiming to lessen the country's reliance on the real estate market by curbing speculations. A common refrain in Xi's speeches is that houses should be used for living, not as investments. These actions led China's debt balance to grow higher. The Chinese government's action to fix this was to implement the 3 red lines policy, which establishes maximum levels of debt financing for real estate projects. Regarding this, Federal Reserve pointed out that overvalued real estate could fall due to crackdowns by China's communist leadership. The three standards or lines are as follows. The ratio of liabilities to assets must be below 70%, the ratio of net debt to equity must be below 100%, and the ratio of cash to short-term debt must be equal to 1. For each red line that a company meets, the limit on annual debt increases by that company is 5%. This policy would be of help should have been enacted a long time ago, but it hasn't. Cathie Wood has compared the CCP's new rules, which could destroy the property market, to playing with fire. The developers have gone too far into debt, and it will be impossible to get them to return to square one. She added that this was also observed during Japan's 1989 real estate crash, where corporations were encouraged to borrow capital from corporations. Like China, their economy showed a rapid ascent to the top rankings, but by 1992, the Japanese stock market had dropped by about 60%, reaching a low of 15,900. The Nikkei index fell over 45% during the next 2 decades, for a total decline of 60%. The lost decades refer to the time period following the crash during which stock prices remained down. Cathie shared her forecast that China's GDP will contract sharply over the next 3 to 6 months in Ark Invest's most recent quarterly report. Cathie predicted that in the following 3 to 6 months, investors would be increasingly concerned with the possibility of a U.S. recession, the severe downturn in the Chinese and developing market economies, and a possible unexpected decline in inflation. The real estate upheaval in China may have contributed to a 35% reduction in iron prices, while the Baltic Freight Dry Index has fallen more than 40%, and drum prices have been down 25%. No matter where in the world you are watching this, you will feel the effects of China's economic doom. As the Chinese economy further slides down, its foreign relations will most likely feel the effects of its dip, driving us to the possibility of drowning in inflation. This being the case, what do you think about Cathie Wood's viewpoint? Or is the Chinese economy's collapse indeed due to transition? Feel free to tell us what you think in the comments below. We hope that this video helped you to know more about China's economic crisis as it affects all of us. If you like this video, please show us some support by giving us a thumbs up. If you want to see more of this content, hit the subscribe button and ring the notification bell. Thank you for watching and see you in the next video.